Thanks for coming this afternoon. Please feel free to come down. This is a fairly informal session. I hope by going through this process we get some interaction and questions. My name is Jim von der Heydt, and just as a little bit of background on who I am, I've been working with startups and new businesses and creating new businesses for over 40 years now. So that's a little bit of time. And I don't pretend to be an expert, but I do have a lot of experience. And what I wanted to try to do this afternoon is just share some insights about what it really means from an angel's perspective, from an angel investor's perspective, to look at a pitch from a startup company. So if you're not here for that class, either take a nap or here we go. None of this is vetted by any of the organizations I'm involved with. This is all my own opinion. So I'm pretty sure I'm wrong, but I'm confident in some of these ideas. One of the things that I've done over the last, since 2004, is I've been involved with the St. Louis Archangels, and we have screened we've probably seen 2,000 business plans through that period. We've invested in 60-some companies, $65 million. More than anything else, we're sort of in the middle of the deal flow here through I-10 and through Biogenerator and from a number of different sources in town. So I literally have a pile of business plans on the floor of my office that's about this high. And what I wanted to try to do is demystify some of the processes. So how many of you folks are doing a business plan or in the process of trying to solicit money on behalf of a company? Okay, so hopefully this is relevant. How many of you have already presented to an angel investor group? Okay, so you're right in the hot spot of where I hope I can help you this afternoon. The first thing I wanted you to know is angels are people too. That may be frivolous, but it's really true. You know, we as angels, as early stage investors, are doing this because we're passionate about it and because we want to make some money. But there really, in my opinion, are a couple different types of angel investors, and there's some that I'd like to try to suggest I steer you away from, and some that I would steer you towards. I would tend to steer you away from an angel investor who doesn't do it professionally. And those are people, I just lost my slide. Those are people who are friends, relatives, rich neighbors, mothers-in-law, and people who don't have real experience in investing in early-stage companies. What we want when we start up a company is smart money to be on our side. Now, the thing about the ones you want are serious business-based people who are building a portfolio of early-stage investments and who have committed a significant amount of their time and energy to doing this. They're also going to be your toughest customers. Because in a little bit, and meeting with angels for the first time, especially if you've never met with any professional, anybody outside your vision area, it's like getting your first physical. I mean, this is not a pleasant experience because the first financial assessment of your company is being made by the most rigorous investor you're ever going to meet. So there's a big contrast between what you may think you have ready for that person and what that person is going to ask you to offer up. What I want to go through in the next few slides are 7 key slides that I think you need to have in your pitch deck to be ready to present to angels. So, how many of you are golfers? Have you ever tried to play golf? Well, I don't know about you, but when I started to play golf, I was about 8 or 9 years old. And I grabbed this cool 3-wood, and I ran out to the practice range, and I hit the ball as hard as I could. I thought I was learning how to play golf. Well, do you know that something like 42% of all the shots made by a professional golfer are putts? And I have a hypothesis that most people learn golf backwards. You should start at the cup and work back to the tee, not start at the tee and work to the cup. And why is that relevant? Well, emotionally in golf, it means that even if it's the last 12 inches, you've sunk the putt. So you walk off the green with some modest satisfaction. But it's also a demonstration that for most of us, when we try to do things we've never done before, we tend to go about it instinctively, and often that's backwards. Let me make that characterization now for what it means to be putting a pitch deck together for a company. I've done this several times. I've been involved with raising close to $60 million for startups just here in town in companies I've been involved with. So I've been on both sides of the slide deck. And the thing about it is that we start off with this huge pile of slides that we're going to make our pitch deck from. I had a scientist come to me once with a startup, and he had about 75 slides. None of them were useful. I want to argue today that the best way to create a pitch deck is to build 7 slides first. When you sit down to organize your company and your business plan, if you think about the content of these 7 slides, and then build your presentation and answers from there, I will contend that you'll do a better job making your case to early stage investors. So let me take you through those slides, what those points are, and then I'll be happy to come back and answer questions. Here are the 7 slides. The perfect pitch deck, in my opinion, consists of a problem statement, the solution, that's when you do your aha and present your product idea, proof that there's a market for your product, how your product is competitively insulated from others in the industry, who your management team is, a demonstration of the profit and loss potential of the business over the next 2 or 3 years, and what your offering is in terms of how much money you're trying to raise at that time. Describe what it is you want from the investor, okay? 7 slides, it's that easy. If we start by building 7 slides, the deck can get bigger from there. But think about it in the sense of who these angels are, these professional angels are that I want you to be in front of. We've seen 45 feet of these things. We give you about 90 seconds before I stop listening. If you haven't attracted me by the clarity of your speaking, the clarity of your ideas, and intrigued me by the fact that you're in a market or a segment that I'm interested in investing or learning more about, I'm out of the room. Good. You don't want to talk to me anymore. You want to go on to the next person, right? So the goal is to, kiss a lot of pigs, right? And frogs, and see which one happens to turn into something. So the idea is to get this statement out very clearly and very early. Those 7 slides. Let me take you through the content of what those might be, what those might look like. Okay, the first slide in your deck should tell me what industry you're in, the segment that you're in, and what the problem is you're going to solve. I'll come back through this and give some examples in a minute. You see the number of words on this slide? Don't put any more on than twice. Okay? Really simple. Because this is the entry point to your story. And if you've got your audience's eyeballs running all over the slides, first of all, they're not listening to you. They're trying to figure out the words on the slide. And the point is you want to get their head into your industry and validate that there's an opportunity that you've identified. Okay? Next. What's your invention? Aha! Show me your product. Tell me what it is. Slide 2, not slide 23. if you're trying to sell me a cure for toenail fungus, don't start with a slide about global warming. Okay? Start right where you need to be. Slide 2 is, I cure toenail fungus. Why? Because at this point, you've either got the person interested in your industry, in your space, and understand. So you have to draw a picture. You have to put a slide up that explains what your invention is, right, clear, and early. It should be very exciting because you get to show your stuff right away. But it forces you to boil down. I would say that 20% of the presentations we hear, after the first 7 minutes, I still don't know what their product is. You've lost me. You've lost me at so many different levels because, first of all, I don't think you really know what you're talking about because you can't tell me. And I've lost my confidence in your ability to be a clear business thinker. And those are the kinds of questions that are running through my head. Can this person express a business idea in a clear and articulate manner? And if you can't explain what your product idea is, you better go back and write a new slide. Prove to me there's a market for your idea. And don't tell me there's a market for your idea. Show me how you have gone to customers for the product and they've told you they're interested. Show me that you've mocked up a prototype, mixed up the soup, figured out a way to get it in front of a bona fide customer, met with a potential distributor and have them say, when that product is ready, I'm ready to go. If you can't prove to me that there's a customer opportunity, that someone has already proven to you that they're interested in buying the product, I'm not ready to invest. So I'll boot you out the door and say, come back when you've got consumer proof, customer proof. And it doesn't have to be quantitative data. It has to be something that makes empirical sense, right? Just give me a compelling idea and proof that you've actually been in front. Why is this an important question? I want to know that you understand your market and that you've been in front of your market. So many entrepreneurs project that they have a solution that the market needs and spend a whole lot of time developing a product and never talk to the customer. Let me tell you, I've done product development for years, and I would be embarrassed to tell you how many great ideas have fallen flat in the face of consumers. But once again, it's a quantity issue, right? And if you listen to customers, we can actually get some better answers. So I want to hear that you've been in front of your customers. How is your product competitively protected? Now, a lot of us turn to trademarks and patents as the first legal boundary, and of course they are a legal barrier. But in actual sense, there are some practical barriers to competition that can often be more important. Like the fact there's no direct competitor. Nobody else has one of these, and I can prove it to you. I've searched the industry. There is no one else who has one. Or I have a business plan here that allows me to be the first mover in my space. However, I've written a business plan that has enough scale to allow me to convince you that we can actually capture a significant portion of that market. Okay? First mover is not something to be shy about trying to obtain. In fact, often companies, in my opinion, spend so much time worrying about capturing intellectual property and patent protection, particularly in markets that are highly fragmented and filled with major competitors. You sort of scoff at them because you realize that anybody that's well-heeled is going to either reinvent your product by re-engineering it or run you over. I mean, we just had a case closed about Tapestry between Google and Tapestry. They lost their suit on a trademark, on an IP issue. Why? Because Google had deep pockets. It's a simplistic answer, but you know, big guys win. So, or there's a lot of talk about business models, right? But your go-to-market model may be disruptive. It may take a step out of the distribution channel, for example. It may go direct to a customer that's never been served by anything other than a distributor before. At which point you got 30 points of margin advantage. You found a way to get to a customer more efficiently than anybody else who turned the market upside down. Lots of examples of that. So your business model can be a competitive advantage. Tell me about your management team. Please do not give me any pictures of the choir from church. I don't want to see 23 people all lined up who really aren't doing anything. I want to know the 3 or 4 people who are really working on your company. I want to know what they've committed to it. So your core management team needs to be working on the project. They have to have credibility in their experience that they've actually done something like this before. It gives me confidence that they have at least business acumen. Then in addition to that, we like to see a board of directors that is experienced in the way of early stage companies, and a group of special advisors who might be providing with scientific oversight, technical support, or other validation. What this says to me when I look at a management team that has a good board and a quality set of advisors is this entrepreneur knows how to listen and get advice. So when I see this kind of slide that's compelling, I'm checking off in my little mental box, coachable. One of the criteria we look for in angel investing is the management team coachable? Because we're joining the team. My money, your passion. We want to align together. So I want to know that you have the ability to listen, that you can respond thoughtfully. You can tell me when I'm heading in the wrong direction, or you can give me a thoughtful response and say, well, let me work on that. Odds are your management team and your board will broaden your horizons and abilities to address situations that are fully unanticipated by your company. Don't show me anybody that isn't working on your project.
So can you elaborate maybe
Sure.
just a little bit on board of directors? You know, they have skin in the game. I mean, if it's a small company and you're just formulating it, you know, I've heard people say, okay, you should have like an advisory board, business people that can give you honest feedback, you know, through a different lens and that type of thing. Are you looking for people that specifically have invested?
Not necessarily. They've invested time, if not money. Maybe they have options. Maybe there's some warrants on the table that they can earn based on the success of the company. But there are clearly people who are willing to give you some time to help you formulate your company and are a critical sounding board for management and managers to talk about what really is critical for the business going forward. To keep you aligned strategically. I'll be happy to come back and give more details on it. That's a fair question. I got 2 more slides and I'll come back and we'll take any questions in any order. Slide 6, your P&L. Every early stage investor understands that it takes money to get to certain milestones in the development of a business. Don't be apologetic that it takes money for you to get from one phase to another. Be enlightened, because everybody does it. If General Motors goes out and borrows capital money, every company borrows money to fund initiatives. This is just the first time you're doing it for your company. We like to see that the P&L is linked to specific resources required, like management and talent, and milestones delivered in the expansion of the business. So this is a way of saying over the next 3 years, and oh, by the way, the first 2 years we're losing money. That's why we have to go to the capital market to cover that gap so we can fund the expansion, because our sales aren't going to grow as fast as our expenses. So, you know, of course you need money, but what are you going to use it for? investors know, and the reason to work with experienced investors is we know you're going to need more money even better than you do. And we're prepared, should be prepared, to either invest that ourselves with additional funding rounds or help you get more money from other investors downstream. But the reality, the objectivity that you can show as a management team about what you need to accomplish and how much money you need to do that gives credibility to your acumen as a business planner. Don't be afraid to put in some extra time and some extra money. You'll need it, okay? You'll need extra time and extra money because things always take more time to get done than we want them to, or we think we're going to have them happen to us, and our burn rate is always greater, and there are always expenses that we didn't anticipate. And so go ahead and slog in some extra cash for that. You don't want to be running down to the last lines of credit on your MasterCard to fund this thing. Yes?
Even if you are an early stage company, which
Yes.
is more likely a pre-revenue company,
Yes.
it is expected to show up where you go in like 3 to 5 years. Is that why the purpose?
Yeah, this is a 3-year P&L, and there are different schools of thoughts as to whether you create a 3-year hypothetical P&L for the first 3 years of the business, or 3 years on an annualized basis, a specific calendar. Doesn't really matter. It just depends on what makes sense. But the point is that you have tied your expenses and revenues to the capital requirement of the business linked to specific milestones that you're going to achieve. And staffing is often one of the key things that causes expenses to go up in a big way. And you'll be encouraged to pursue by your investors because you've got to have the right team. And then the last page is the offering. Tell me what kind of corporate entity you are, an LLC or a C Corp. Tell me what your offer is, okay? How much money have you raised to date? Where has it come from? Where are you in this offering? Do you have some money in already? How much money has come from your founders? How much has come from your board? Be completely transparent about it. Then, after we've made this investment, show me your pre and post money. Now, this is often the situation where we get into great concerns about how to value an early stage company and how much angels should be raising, and that can be a subject for several hours of conversation. But you need to go into your investors and say, I'm trying to raise $400,000 based on a valuation of $2 million. My post money is going to be $2.4 million. You're going to end up with 16% of the company after you've invested. And I'm going to use that $400,000 to do X, Y, and Z. I got $100,000 already from my board, friends, and family. I'd like to raise another $300,000 in the form of equity or convertible debt. What do you think? And oh, by the way, when this business is a success, how are you going to sell it? Every business will be sold. Every business must be designed to be sold. This is not a point which is very comfortable with people who are passionate about their. Investors invest in business because they want to get their money back with a premium. How does that happen? It doesn't come off of dividends. It comes out of selling the company. Because remember, the difficult conversation that you're going to have with the angels is, by the way, when I put my money in, I want somewhere between a 10 and 30x return on my money over the next 3 to 5 years. Why? Because I'm a professional investor in early stage companies, and the risk-adjusted rate of return that I need to earn on my portfolio of 10 or 20 early stage angel investments has to give me that kind of return on every deal, because the portfolio tells me 30% are gonna tank, 30% I'm gonna get my money back, and the last 40% of my deals are gonna make all my money. 2 of them are gonna ring the bell, maybe 2 of them will give me a nice warm kiss, and we're done. So that professionalism brings a level of professionalism to your company, to our companies that we're trying to raise money for very early on. It's a very uncomfortable and difficult situation and phase to go through because, as I said, it's like your first financial physical. It's pretty thorough. So, and the thing to remember then is when you're talking to angels, when we're talking to companies, we want to find a partnership. We want to create a collaborative business relationship. We want to build a company together. We want you to be rip snorting successful. We want to share in that success by what we've been able to contribute in capital and intellectual property. And we want to enjoy with you the champagne and steak dinner when we sell this beast to somebody downstream. And we mustn't lose sight that every company, it must be designed to be on the path to be sold. And every year, the board has a conversation about, is this the best time to sell the company? Or should we raise more money? Or should we keep operating it? What's in the shareholders' best interest? That's the fiduciary responsibility of the board. Do you sell it every year? No, of course not. Companies go on for decades. But every year, successful companies have a conversation about what's in the best interest of our shareholders. Should we liquidate? Do we have a strategic partner? Can we get more money? And why should we not be afraid of that? Because we're entrepreneurs, we'll go do it again. This is not our last idea. If this is your only idea, you shouldn't be in the room. We got lots of them. So you do them. Some fail, some succeed. Let me tell you, I've had some turkeys. But I believe that if we go back to this slide, of the 7 slides, and if you're getting ready to meet with angels, or you're starting to think about putting your company together to seek investment, start here on the putting green. Write 7 slides. Don't start on the driving range with 135 slides. It'll confuse the socks off of you. If you can't tell a story in 7 slides, you're not ready to go get somebody else's money involved with your business. End of my pitch. I'm happy to take questions. Please.